You're about to join Jerry Parker, Moritz Siebert, and Niels Kostrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Jerry Parker, Moritz Siebert, and I, Niels Kostrup-Larsen, are back with this week's edition of the Systematic Investor series, where each week we focus on helping you build safer and better performing portfolios by including trend following in the mix, and where we do our best to answer all of your questions. Now, if you are a first-time listener, welcome. We appreciate you taking time out to spend with us, and we aim to make it worth your while. As usual, let me start by saying good morning to you, Jerry, and good afternoon to you, Moritz. How are you?
Hello, guys. Hi, both. How are you?
Great. Good morning.
Doing well, thanks very much. Let me do a quick review of things that just kind of caught my eye this week. I think the two main stories, I would say. One was, of course, that the 30-year interest rates in the US hit all-time lows this week, and that's kind of sparked the government to once again consider whether they should start borrowing even longer than the 30 years that we know as kind of the longest U.S. Treasury. There was some talk yesterday, Friday, that they're thinking about, or at least going to ask what people or investors think about if they were to issue a 50-year or 100-year bond, just like we talked about a few weeks ago, and that Austria has done. So I think that is interesting. The 10-year yield is not quite at new all-time lows, but it's pretty darn close. And of course, the other event that caught my eye this week was the Chinese, of course, allowing their currency to go through the 7 handle, which, of course, for many macro watchers at least, is quite important. The dollar strength story that has played out well, I guess, in our trend following portfolios. Is still in play, a bit choppy at the moment, but I mean there are currencies like the Australian dollar that is, falling pretty much like a knife through butter at the moment. And by the way, the last time I think the RMB started devaluating, it only lasted a few weeks until volatility really crept up everywhere. So I think that's interesting. Also, of course, the tensions we still have in Hong Kong, what that might lead to. But then, of course, there's also things that may not get so much attention in the normal headlines of the news media. And that is, I noticed that the Euro Stoxx Bank Index, which has really been under pressure in the last few years, actually broke what a lot of people consider as sort of key support, which may signal a huge problem for us over here in Europe. And so the ECB, I think, is still on summer holiday, but when they come back, they may have to act a little bit more swiftly than many people think. So all in all, I would just say that, I mean, obviously the themes are the same, but it looks like kind of these macro themes are going to play out for many months, maybe even years to come. So with all that action, Moritz, how was your week?
Slight positive week, nothing spectacular, lots of back and forth in the market, I think. Made money again from the bonds. I mean, this becomes like we're repeating this every week at the risk of becoming boring, but it is the case. Equities, problematic, up and down, lots of volatility, much more volatility than we saw a couple of weeks back. So markets are moving. Gold still positive along the gold market. Long silver made slight gains. So overall, 0.3, 0.4% up for the week. Nothing too spectacular, but happy with 40 basis points.
Nice and steady, and also this continuation of a decent run despite many things happening. I think that is important because it's not really what trend followers have been known for. So I would echo your sentiment, Moritz. A good week on our side. Of course, fixed income, taking the lead in terms of performance. But the single biggest winner for us this week was actually wheat. So that was nice. Made some money in gold like you did. Hogs were pretty good. Coffee did okay. And the euro, actually, not a bad week for the euro. British pound, not so much. And of course, as you say, equities. I mean, for us, we're alongside it on the sort of US, European indices that cost money. But, we're positioned for weakness in Japan, so that made us a bit of money. But overall, a positive week, which we're happy about, of course. What about you, Jerry? There's a lot of action, of course, in the equity markets, but we just see the indices on our side. Does that play out differently when you look at the single stocks that you trade?
I think even on some of the violent days where the markets were down a lot, I go through all the charts with the different single names that we trade, and some of them had, a little tiny budge, and then they're back to new highs yesterday. So it's up and down. We have some shorts. Always have less of performance in the stocks than we would if we traded indices, because we're long and short and flat some. So it looks like your currency charts. Some are going up, some are going down. And it's really kind of destabilizing to flip open my chart page. And the first thing I see is the S&P down, a lot, which I don't really do that with the dollar index. I just sort of go down the currencies and then I go down the commodities, and there's no commodity index I reference. So I'm still contaminated and influenced by how the world has trained me to view stocks, not from our point of view, world view, which is, individual and long and short and follow your systems. But the macro calls on CNBC and the media can kind of get you going and pessimistic, and then only to be optimistic the next day. None of these moves seem to follow through or be very predictive of tomorrow's move.
Yeah, it's funny you say that. By the way, I'm just picking up, Jerry, while we speak, that you may not be coming through your mic. You may be coming through your laptop. Your voice sounds different, so you might want to check that on the setup. But incidentally, what you say is interesting, because I was just listening to a podcast this morning, and they were saying, a fun thing to do is to watch news that is around 9 months old, meaning go back and look at CNBC and Bloomberg, from what was said at an interview, 9 months ago, and see how silly it in most cases really are compared to what happens afterwards. So kind of interesting. I
agree with that. This week was funny. I picked up a few headlines in German newspapers or news outlets saying markets are in absolute panic mode. And that's like, really? I mean, because the S&P is down 3%, is we're in absolute panic mode. I mean, it just makes you laugh, right? I always like this.
Yeah.
No one's able to look at them in terms of the ATR, so that's even worse.
Yes.
Yeah. It's just interesting, I think, in many ways. And of course, what we try to do is not pay too much attention to all of this. And now, Moritz, while Jerry's just fixing his side, were there anything in particular that you picked up in sort of the Twitter world this week before we jump to Jerry's top tweets? I mean, I think it's interesting that, and I've said it before, I mean, there are, so this whole Finn tweet, we started out by calling it Jerry's top tweets in kind of a, to make it sound, interesting and fun. But actually, I think this whole Finn tweet area has really taken a much more serious role. I mean, a lot of really good content, interestingly enough, is being shared by quote unquote influencers there.
Yes, I enjoyed a lot. I mean, we're waiting for Jerry. He's got the repository of the good things there, and certainly we must not miss out Wayne this week because we missed him last week. But I enjoy Twitter a lot. Just in the evenings, reading through things about markets, following up, and there's some really interesting stuff on there every once in a while. So I like it. It's a great source for me.
And we've met a lot of friends. Like-minded people, and we have people who are challenging us, and we feel challenged. So
that's right.
You guys can back up a little bit if you don't mind, but got to take the good with the bad, I guess.
No, absolutely. How was then your? What was the main things you noticed in terms of reactions this week?
Well, I always like to check on what's going on at on Morgan Housel's webpage, Collaborative Fund. He always has some really good long pieces, and this week he had his version of the laws of investing. And once again, I don't think he approaches the markets from a trend following or point of view, or certainly commodities and currencies, long and short, probably doesn't keep up with that too much. So, but it's kind of fun to sort of see how I think I agree with a lot of people like him when they come up with things like the laws of investing. It sounds pretty audacious to take on that particular topic, but I really did agree with a lot of what he was saying. And I think our philosophy does broadly sort of merge into other good things that other people are doing. So one of his tweets was the behavioral side of investing will always be more important than the analytical side, because good behavior and no data can still do well. But tons of data mixed with poor behavior is a lit fuse.
I agree 100% with that. Absolutely. I mean, no critique from my point. You can have the best data in the world or the worst data in the world, but if you misbehave around that data, then you're in trouble, right? And some good, solid, simple rules in the markets, they may be just all you need.
Talking about simple rules, a lot of people, that are interested in becoming more quantitative. I mean, it's maybe a difficult place to know exactly where to start. And I heard something I thought was really good advice or a good suggestion. It's not really specifically about how to become a trend follower, but part of what we do, of course, is we overcome our own biases by following rules. And the suggestion was that the first thing you could start, if you're just running your own portfolio, but you may not want to get into the nitty-gritty of developing trend following models, is to start rebalancing. Have rules for rebalancing, because what you end up doing is, for example, during a crisis like 2008, is that you end up actually, if you have certain limits to your allocation to various investments, you would end up, say, in that case, you would sell some of your bonds that did really well, and you would start buying back some of the stocks that had done really poorly. So over time, that simple rule could help a lot of investors. When I heard that, I thought, even though it's not specifically what we do, but as a starting point, it's not a bad idea. I wanted sort of your take on that. If let's forget what we do in specifically in our niche, but just to a wider audience who may not be that disciplined or rules based, but don't want to sit and try and develop models like we do. Do you think there's any merit in saying, oh, maybe I should just start by having rules for how my portfolio should be allocated and rebalance accordingly? Does that make sense in the way you think about it?
Well, honestly, it doesn't make that much sense to me. But and then I have read papers over the years that critique the rebalancing and the rules, and I think it's a mixed bag as to whether they help or hurt at different points in time. And I think it's just sort of random. I would never discourage anyone from having those particular rules, but I've often sort of said that trend following is like non-random rebalancing. So I prefer to kind of rebalance with the air quotes, using what we do, because that's essentially what we're doing.
Mm-hmm. Sure, I agree.
And then that seems more statistically reasonable to do it that way versus, the long stuff all the time. And then now I'll sell some bonds and buy stocks. I mean, should you be buying stocks now based upon the bonds? I've never thought that was a good idea, that in any regard that you should make a decision in market A based upon what market B is doing, or C, D, E, and F too. So yeah, not kind of in favor of encouraging. I can't honestly say I think it's going to be beneficial. Not sure.
No, I mean, I take that point, and that's fine. But funnily enough, what you said just before about making decisions based on what other signals are doing, I do actually think that some of our peers have gone down that route recently in the last few years, where they start doing this, I don't know what they call it, cross-asset momentum, whatever. And I know that's maybe not what we're advocating, but it certainly seems to be happening. Maybe as in lack of finding success in traditional trend following, some people try and come up with these new ideas. Anyway, any thoughts, Moritz, on these topics?
Yeah, I think it makes sense to have some rules for asset allocation. So it's not just bonds, buy and hold, long only, or stocks, buy and hold, long only, but it's a mix of things. That to me makes a lot of sense. The rebalancing thing, I mean, when you're saying something that, has gained in value and you're saying you want to rebalance that, then what it means is that you're going to sell something that has risen in price and you're going to buy something that has been a relative underperformer. So it's the opposite of what we're doing. Mm-hmm. And I'm more in Jerry's camp to say, let's use our trend-based rebalancing rules to prevent that, right? To stay with the trend and not allocate to the underperforming assets, but stay with the trend for as long as we can. And when we do get a rebalancing rule, meaning the trend has shown us that it's no longer there, it breaks, right, to the upside or the downside, then we rebalance and we do something else with our money. Or maybe we do nothing at all and we stay on the sidelines. That to me makes a lot of sense. But this requires a model. That requires development and, work and understanding and experience, research, all of that. It requires time and effort. It doesn't come for free. And like you say, Niels, maybe, if you understand the benefits of that way of trading, it may be worthwhile to allocate money to an external trend following CTA, as opposed to going down the route of, acquiring data, building the models, buying software and all that type of stuff. And quite frankly, using a lot of your own personal time on building that model. I mean, to us, it's a source of enjoyment. I mean, it doesn't feel like work or anything like that. I really love that work in quotes, right? So it doesn't, it's not a negative in any way, but it may not be for everyone.
Funny you say this thing about that it's not free to do all that work, but yet a lot of, I think, investors nowadays feel that it should be free.
No, I don't think
trend
so.
Following, anyone can do trend following, right?
No, I don't think that's true. The good things, the good systems, they have a price tag, and I think they deserve that price tag.
Yeah, I agree. What else happened on in Twitter land on your side, Jerry?
Just continuing with that same article, I liked this. He said, nature does not ask your permission. She has nothing to do with your wishes and whether you like her laws or dislike them. You are bound to accept her as she is, and consequently all her conclusions. So it goes with every field's laws, including investing. And this is sort of reminds me of how I've never been a fan of, find a methodology that suits your personality. I think that if doing the right thing, which, we consider to be medium to long-term trend following, long and short, currencies, commodities, stocks, bonds, making sure we take small losses and riding the winners, then maybe you shouldn't be doing this. But, to sort of say, no, I really don't like that. I'd rather make money about 1% a month. And I don't want to have 40% winners. I don't want to wait around for months or years for these outlier trends. I'm uncomfortable with all of that. So I'm just going to go out and find something in the market that really suits me better. I think that's silly. You'll be lucky to pull money out of the markets pursuing something that's very difficult and counterintuitive and goes against behavior, how us humans would like to behave. If you can even come across those ideas like the three of us have at our firms, then you'll be lucky to be able to stick with it and pull money out of the market. But on top of that, make sure it's something you really like. Oh my gosh, wrong-headed.
Any thoughts, Moritz?
Yeah, lots of things in there. It's about being comfortable with your own trading system and your style of trading, right? And I, just confessing that at the very start of a trend following type of trading career, that hasn't been comfortable at all. And even these days, it is not a comfortable trading system, right? Because you're forced to take positions which, are against human nature. Like one example, just in recent weeks, we've had this upside breakout in nickel. And, when you don't have a trend following trading system, buying that thing right now at the current level is incredibly tough to do, right? Because you're picking a very high point, or so it seems. But, we've seen it so many times that, you buy the high and those markets just tend to go higher. But you're in a position of being uncomfortable with your own action if you have to pull a trade like that off. So you need that system, or at least I need that system to just do it. And I know that, the way I trade it, the way I control the risk, I'm protected, and I'm diversified, and I'm doing this long and short and in appropriate sizing across a large portfolio. That to me is the only reason really I can pull that thing off and buy that high. And it makes me happy with my trading system, very, keen to follow that and follow the rules. But is it always comfortable? No. I mean, it's getting better with the years, but not all the positions I take are comfortable positions. In fact, the ones that are uncomfortable tend to make the most money, I think.
Yeah, I mean, we obviously hear that a lot when people say, do something you're passionate about, do something that you love. And I think that is just yet another, contradiction that we have in our industry, is that, and maybe that is why it's not for most people to do trend following or to invest in trend following. Because it doesn't sit well with that thing we've been maybe told by our parents, go for your, passion, go for something that you love doing. So you really have to embrace all those other things that you mentioned, Moritz, and to appreciate the value of those, and what that might give you 10, 20, 30 years from now. Pretty good point.
I feel like, recently I've just spent too much time thinking about how to execute this trade. And there's just been a lot of multi-ATR moves during the day. Corn, gold, silver, nickel. And I'm doing these trades and I'm spending way too much time nuancing them, like, oh God, okay, nickel, what are we going to do? It's up a lot. Let's wait for it to settle down. Silver, oh my gracious, this thing's out of control. We got to sell some corn. It's just crashing. And so, we spend a lot of time on, here's the system. And we have to plug into the computer. Well, we're going to buy on the close. We're going to buy on the open. We're going to buy during the day. Okay, it doesn't seem to matter that much. So here's our strategy. Go. But then we are presented with, seemingly during the day, these incredibly important ideas, situations where we've got to execute this silver. And it's, as soon as you put it in, it's near the high, you get filled at the high, then it's, makes low of the day. And you're like, oh God. So I find myself constantly being kind of bummed out by this, which is just so ridiculous, just do the trade and move on. And so I think that, that's not how, that doesn't give me a lot of comfort. But I remember back in the day thinking, when I was taught all these ideas, the idea that it should be hard, it should be painful, this is not something that's going to fit your personality. I was like, oh, that does fit my personality. I do want to trade in a way that makes me very uncomfortable. So I was always able to embrace, this newfound wisdom of buy here, sell there. But why are we buying there? Why are we selling there? Why does this work? And what are we trying to replicate? We're trying to take advantage of people don't like to buy highs, sell lows, take small losses, ride long-term profits, sit there and do nothing. And it's based upon this uncovering of psychological things that people don't like. So embrace that you don't like it. And that suits my personality, because my personality was, bottom line, just be successful. And if that's what it's going to take, and I wanted to be so different, just embracing, can I please be different than everyone else? Just follow prices, follow trends, be long. We left out a great move this week for us was short cattle. I wanted to trade cattle. I wanted to meet people who would laugh about trading cattle because, they were so much smarter and so much better because they only traded equities.
I know those rules, they help us take the uncomfortable trades. And just, one add to what Jared just said on, buying a market or selling a market. And when you buy, you pick the high, and when you sell, you pick the low, and you're getting filled there. And it kind of like it tends to be that way. In my experience, 75 to 80% of the cases, you do the trade, and you're picking the high, right? And then for the rest of the day or for the next 1 or 2 days, it moves lower, and you feel like, oh my God, there we have it again. And here's the one exception this year where kind of like it doesn't seem to happen, which is the bonds. I mean, right now I almost have no signals left to get me any longer of the bonds. But the last couple of weeks and month, having bought the bonds, it's kind of like, yep, buy them. Next day you're higher, no problem. Very easy trade.
I mean, I think you touched on two important points in that discussion. And one is, of course, that because it is so hard and so difficult and uncomfortable, that's probably why it works, right? Because it's not going to get overcrowded, in my opinion, to the extent that other things might. But the other thing I think it brings up is, and that is, now, if you're an individual or a small firm, where you are both doing the research and doing the trades, etc., I think that's a harder job to do than in a firm where it's not the people who do the research that does the trades. The traders are just there to execute the trades, no question asked. They don't, and so they have, maybe one way of saying it, I mean, that there's less of an emotional attachment as such. It's just a job, and I don't mean this in a negative way, but it is their job to get the best price, of course, during the day. They use their experience, and I think there's a lot of value in that. Having really experienced traders, that's certainly something we see on our side. But just having it completely removed from anyone else, I don't know. I think it makes things a little bit easier.
Yeah, I think that division of duties is just a key part of discipline, where the computer is telling you what to do, and you're going to do it. Someone else is going to execute it, and any sort of changes or impacts that the market can have on your trading it's a process to go through to change it. It's kind of, we get into these systems and trading, and I had a large company at one point, and it was a process, and no one was able to kind of step in and say, okay, let's reverse these positions or take positions off. And there was risk control that you could implement when necessary, but that's really a good thing to set up an organization. It's much different than in 1983 when I'm sitting in front of a quote machine, and I had the rules in my head. And of course, I was prone to override and ignore. But yeah, somehow we could get a lot more consistent if you have a process like that.
And maybe that's the key, right? And I mean, when you talk to people who are looking to invest and get exposure to trend following, what it's really all about when it comes down to it, it's whether or not they believe in the process. It's not about a single trade. It's not about, 1 day or a week's performance or even a month or a quarter or a year. It's, do you believe following this process will, deliver a certain level of return that you would have expectations to, of course, over the next 10, 20 years. And I think that's the hard part, to really know inside yourself whether you can stick with that, always following the process.
I think it's important to understand that all these tweets that I'm reading are coming from people who are not trend followers, or probably just stock people, probably mostly indexing type. But I want to read a couple more, and just keep that in mind as you sort of process how they sound like they're kind of trend following, or understand what's going on in the world. Quote, "It's easy to underestimate how rare and powerful tails are. Tails drive almost everything. The takeaway from tails is that you should be comfortable when a lot of what you do and see doesn't work. The right way to think about returns is through expected value, reward times probability. It can make rational sense to speculate on low probability events. It can make sense for someone to speculate on long shot, crazy looking ideas, long bonds as they approach zero. It's crazy long shot. But you just have a process where, we've said before, when you have a situation where the downside is defined. It's not always going to be your 50 basis point loss or whatever, maybe some gaps or whatever, but you do have, hey, if it doesn't work, it's not a big deal. I'm not going to hurt myself too much by taking the small loss And then it's just a superpower. Stop losses are like a superpower, or your systematic approach that mimics, stop losses that don't let the losses get out of control. Then what do you have to lose? And then once you have that profit, you really have a superpower, because you're just like, I can afford to hold on and watch this thing go, and people criticize it and no one agree with it. And it's just really fun. And then you sort of understand, though, who's doing the heavy lifting in this process? Is it me, or is it these markets that are really crushing it? And all I did was follow the system to get on and then do nothing until the exit was hit. So the markets can, at some point in time, they can really become the superstars, and they're handing us this money. And we're like, I don't know if I deserve this, but it's really fun to watch.
Interesting point on the tails. As you guys probably know, we've had the market threw us a massive left tail this week. I think it was a 20 or 21 sigma downside event in Argentina, with the Argentinian stock market dropping, was it 48% in dollar terms and close to 40% in peso terms, Argentinian pesos. And so events like that, they're supposed to happen once in, I think, 96 zeros or something, whatever crazillion number that is, right? So they're non-existent in statistics, but yet they happen. And we've mentioned that over and over again, that stuff happens. Now, do you want to bet on those type of tails? I'm not so sure. I mean, there's tails of a smaller magnitude that happen more often, like, the 2 and 3 sigma type of event things. And there's funds out there which we know who permanently trade on the long side of volatility, buying options, buying convexity to the upside and the downside. And, they're positioning themselves to make a lot of money as and when those tails materialize and show up. But you have to go through longer periods of, not making money, underperformance, paying away premium. And here's the important thing, you have to be there, and you have to have the right position on when that tail event happens, right? It's important to be in the market before that tail event happens and not after, because they're like so idiosyncratic, so rare. You just have to be there. It's a very, very different style of trading compared to what we do, because it's so much more episodic as to when you're making P&L, and so much more painful and longer spread out that you're on losing streaks. But those funds, they tend to survive. I think they have a higher probability of survival than those funds which constantly short volatility and do nothing but.
Yeah, but you bring up a very important point, and that is you have to be there. I mean, so yes. Even though they are there when it happens, and they somehow miraculously, pay for all the losses and make up for it. But it's the same with trend following. It's actually the same with a long only investor. If you really want to make money from long only, I think there's some statistics out that if you missed the 10 best days in the last 20 years of the S&P, your returns would be significantly lower than the actual return. The same with if you missed the 10 best months of Dunn's performance over the last 45 years, your returns would be significantly lower than what it is. So, and that's what I meant before when I said you have to convince yourself that you believe so much in the process that you will stay for the really long term. Otherwise, exactly right. as Jerry said, then it's not for you. I mean, if you then go find something else. Yeah.
It's a very great point, Niels. It really is about the process, and that you have to have that process active every single day, right? Because those events may come when you don't expect them. And like you say, even with us trend followers, if we erase the 10 best months from our track records, it would look much, much, much different, right? Now, here's the thing. Like I sometimes read on Twitter and on websites that, when you're trading, that every once in a while you should take some time off and close your portfolio down, go on a vacation, not think about the markets, and kind of like refuel that way. I think that idea is great. And, I sometimes take time off and, not to be too close to the markets and, not think about the S&P and all of that stuff, right? But I keep my system running. It allows me, the way that I trade allows me with a few mouse clicks every day, which don't bother me at all, to keep the system running, to keep the process running so that I can be there when things happen, right? I don't want to be, I think, if you're in this for a business and, you want to make money, it may be very dangerous to say, I'm now off 6 weeks on the Fiji Islands. And then when you come back, here's your 100% that you could have made, but you've missed it. And guess what? It's not coming back for the next 20 years. Enjoy the wait.
Sell in May and go away, which is something a lot of people love saying, but they shouldn't do it.
Yeah. As I was saying before, I had a tweet this week where I said it's essentially, try not, if you're trading, if you're really heavily involved in the trading, like Moritz and I are, we're actually looking at the markets, doing trades, and then, maybe don't try to do too much Monday through Friday. Just execute the system, and then have a 2-day work week, just on the weekends, where you're really looking at how you did and maybe thinking about some projects and research and back testing. So maybe this vacation, because I was instructed to take a vacation every month or two, back in the 80s when I started. I can understand that, but I would never close it all down. I would just tell my friend, okay, I'm off this week, try to rejuvenate. So just here are my stops and stuff. So I think it's good to get away. Maybe that idea is a little outdated, as we've talked about the different duties that people have at the larger firms. But a 2-day work week should be pretty appealing to most people. And that maybe you can kind of do something similar to that. But whatever you do during the week, don't try not to make it, especially a week like this past one, where you have major moves and coming up with these brand new great ideas, because the S&P is now down 800. How am I going to prevent this from happening? That's probably not a time to get into heavy duty research if that's your job or responsibility.
There's that. I mean, first of all, of course, Tim Ferriss became very famous with the 4-hour work week. So I think the 2-day work week is also pretty appealing. So watch that space. But also, I think the other thing that people forget, and I think that makes it even harder for people who are trying to do this on their own. And that is that, science tells us that when we're under stress, we actually we lose a part of our IQ. Simply we don't function as well as we normally do when we are under stress. So you're absolutely right. I mean, if you're loading too much on yourself during the day, the outcome is probably not going to be great. So I agree with you. I mean, do the research when the markets are not taking up your energy and attention.
Yes, and look, I'm on a vacation right now, and I enjoy just reading a novel and not reading anything about the market. So of course, there's a little bit of Twitter and FinTwit stuff going on in the evening when I enjoy a glass of wine. But other than that, I'm much more distanced from the markets, which I think is a good thing. But one thing I'd like to add is when we're saying we're in that great position to be able to follow a process and have a vacation at the same time, I think it's worth mentioning that getting to the stage where we're now able to follow the process has in itself been a process. I remember when I started trading the first, trend following system, that was super, super clunky. And it took me a lot of time every day, to run through it, to produce orders, to, do the checks and balances, to re-import trades, to look at fills, manual processes, all of that stuff. So very time consuming. And it's been, it's taken me years, quite frankly, and that's been a process to get to the stage where really literally it's not even 10 minutes. It's like, pumping up the computer, getting market data in, putting a few mouse clicks, running the thing, producing orders, shutting it back down, done.
I was just going to say, but unfortunately, a lot of I think a lot of times trend following is being sold to people like, retire as you desire. This takes very little time every day and you'll make tons of money over time. But they forget that the first 10, maybe even 20 years, it does take all of your time and so on and so forth. And I remember just from when I come to our head office in Florida and I see the punch cards from the punch holes machine that Bill Dunn and his son Daniel, where they would go to the library every day and use these punch machines to calculate the rules our initial trading system. I mean, imagine the time it took to run these trend following models back then. So I completely agree with you, Moritz, that this is not easy. And so anyone who thinks that they should start doing trend following because it can be done 10 minutes per day, that's the wrong reason to do it. They may end there, and I hope they do, because it is an amazing, how should I put it? It is extraordinary how much you can do with the right set of rules programmed in the right way. I mean, it really is, as you say, you can do it in 10 minutes, but don't forget that it took you maybe 20 years to get to that point.
Yeah, and I think having mentors and experiencing trading through people who've gone through it, and this is very important. I wasn't just given these rules, but I lived those rules with people who were experienced and very knowledgeable. So I think that's very important. But at the same time, this Argentina issue kind of made it out to the press, and I was reading about it, and my friend sent me that text message where he said it was 130 something or 140 something, followed by 96 zeros. This is how often it's supposed to happen. At the same time, I saw this very prominent cartoon, basically someone tweeted, ironically, talking about any sort of concern that people had in 2008, because the S&P lost 48% as well. It just wasn't in one day. Oh, so that makes it better? But his point was, all this concern you have is misplaced. All you people were walking off the cliff, walking away from equities, being concerned. One person in this cartoon took the other turn and just maintained calm and collectedness, knowing that his little buy and hold was going to be just fine. And I just find that so absurd, because at the essence of what happened and what we do is be afraid. Be very afraid. This is money. This is your life. You do not ever want to suffer a 48% drawdown one day or over many months like the S&P had. It's irresponsible. It's not right. Everything inside your being is right. It's telling you this does not feel right. But we're told through this religious experience almost that don't be weak. The only thing that works is owning the S&P in a passive way. And our gut tells us this does not feel right. It isn't, and it's not right. And so with the trend followers, where we come in with moderate leverage, trend following with the positions long and short, massive diversification, attempting to take small losses, before all hell breaks loose, we have a good plan. It's not dependent upon do I have this short-term S&P system that's going to get me short at just the right time, add all this protection in crisis alpha. No, we come in every single day. Our actions are showing everyone we are very conservative and concerned. This is a dangerous world. And even though those type of moves are rare, we are going to proceed as if bad things can happen.
And I think, in addition to that, of course, what a lot of people may not know is that the way we start the process of designing systems is really by looking at the risk. It's not about how much money we can make. It's about how do we control the risk of the system, of the model. That's the important part. The returns will take care of themselves if we get the risk management right. And so, I love that point. So, and I think it just goes to show, and you bring this up today about Argentina, et cetera. I talked about things happening in the US, record low yields. I talked about the banking index in Europe that is already down 90% from the high, breaking to new low. I mean, things can happen. Things can go badly wrong in a world, and it must be incredibly difficult without rules, or without at least a strategic asset allocation in many different assets, to really know what to do in a world like this, where clearly there is no limit to what extreme policymakers and so on and so forth will go to which makes it even more surprising to me sometimes that not more people have embraced what we do. Because to me it makes a lot of sense that in an uncertain world, you need to be disciplined, you need to follow strict rules, you need to manage your risk first and foremost. And as to quote you, Jerry, as you often say, what's not to like?
What part are we going to abandon? Small losses? We're going to go for bigger losses and smaller profits? Less diversification? No shorts? Not being systematic? Just wing it? I mean, break it all down. What part of systematic, diversified, long-term trend following do you want to get rid of? Stocks only? Now? At this late? Yeah, maybe. I don't know. I'm too nervous. I think it's ironic that we trade cattle or commodities. We use leverage every day. And yet we're the conservative ones. We're the ones who are afraid to be long stocks and just blindly watch as we just don't have to do anything. I'm all for being long-term, but I want to do a little bit more than nothing. I think that's the way I don't want my system to be too crazy. Let the markets do what they're going to do. Don't botch up this bond trade. Do the trade, hang on. There's nothing to do here, but I'm not going to hold on forever, or with the stocks either. So I'm going to do a little bit more than nothing by just, when that trend turns, we'll happily take those profits.
You wanted to say something, Moritz? Or you look like
no, nothing to add. This was just perfect. What's not to like? Love every single thing of it, right?
Yeah, and I think also when you talk about these things, Jerry, as things that are risky, trading these commodities and all of that stuff, but it's always appropriately sized, right? I mean, there's no more risk in cattle than there is in the Bund. Not to us, at least. There could be to others. But for us, it's always appropriately sized.
That's right.
And as the world heads to chaos, and all these crazy things happening, and as we set off air, I need to go and read and listen to this one gentleman who's saying he sees minus 3% rates, maybe at least in Europe. This will become readily apparent, with all the biases and resistance to more diversification, more rules, more capital preservation will melt away. And we may not see it in our lifetime, we may not profit from it, but it's inevitable that even things that look to be safe and the consensus is we're certainly swimming upstream now, but this cannot last forever. We have a superior product, and that superiority always wins out amidst massive resistance to change.
And we even won over some of the press this week, because I thought there was a positive article out about trend following this week in CTA Intelligence. So, not surprising that they were maybe some of the first people to come out and say something nice about what we do after all the negative press we had last year and the beginning of this year.
Well, didn't you say it's fun to look 9 months back at the old news when we had the extinction event for the CTAs? I think this is 9 months back in December or January of last year. So how things have changed.
Yeah, and I think actually some of the biggest negative articles came out on Bloomberg, right. And that was in late February of this year. So they're still to revisit that those write-ups. Anyways, what else, Jerry? I know we have one question this week from Craig, but I would love to see what else you found interesting on social media.
Well, I think we can end there. I just wanted to make one more comment that I thought that one of the best parts of all of what we've discussed is this same tweet where at the very end he says the takeaway from Tails is that you should be comfortable when a lot of what you do and see doesn't work. And I think that is really the essence. Are you going to be a person who is immune to your stuff not working? You don't care. You don't have it doesn't faze you whatsoever. I'm kind of late to this trading psychology and having I think there are firms, big hedge funds who have like professional psychiatrists and psychologists on staff I got motivated by this by the TV show Billions, where the woman who plays the psychiatrist, psychologist, the counselor has a prominent role on the TV show. And I'm like, yes, this is so amazing. I think there just needs to be a department and resources for traders and researchers and trend followers and systematic as well as discretionary, because we're fighting these battles all the time in our head. No matter how much success we've had, it's just a new clock. January 1, I remember walking into the office many years ago, December 31st, and we had just pulled it out and had a better year than most of the other CTAs and the ones that I was concerned with, and just pulled it out, the last quarter, last month. And I said to myself, never again will I question that. That is ridiculous. Look at this gift you've been given, this knowledge you have. You've got to embrace it. And then, January, February rolls around. You're like, oh my God, what's going on here? The trends, where are they? Clients are calling and being destabilized by, people who don't get it and don't love it and embrace it. So I just think that is where it is. And, can you handle, what is your mentality when what you do doesn't work and you get the calls and you're just, are you paying attention to the numbers or the emotions and the criticism? And whatever it takes to get you to that really high level, because this should be fun and it's going to have an impact. It's going to have an impact eventually. You may be able to ride it out, but your research, your approach, how you talk to your clients and your employees, and your colleagues, I think this needs to really, this is a great idea. I think I wish I had availed myself of more, counseling. We need some counseling.
No, I mean, I think that's a great point, and I think a lot of the feedback I get from emails from our listeners, which are very kind and very nice, but certainly a reoccurring theme is that they think it's a great resource because they can hear that even the three of us who've been doing it for decades, that it's not it's not an easy thing to do even after all these years. So of course it's even harder probably for people just getting started or having done it for a short period of time. But it brings up one thing that I would say. Now, of course, since I'm based in Europe, I'm not in our headquarters every day. But one thing that my colleagues who have been there for 20 plus years would always say is that one of the things that was just amazing with our founder Bill Dunn is that you could never tell on him whether we were up 5%, 10%, 15%, or down 5% or 10% or 15%. There was just no difference in the way he would act or operate. And seeing that, I think, is an incredibly gift as a mentorship. And I'm sure it's the same maybe with you and Richard Dennis, Jerry. I think that is something that, it's a true gift if you can be surrounded by people like that when you're trying to get the hangs of this kind of, investment approach.
Yeah, that's exactly right. I think just looking back over the charts and these long-term trends, and I like to put up weekly charts and see what matters, see what's mattered over the past 30 years, and then watch these markets and you kind of look at some of the, I guess there's been some bad days in this bond trade. There's been some down days, some sell-offs. But after you look at the trend and it's over and it lasted and it made a ton of money, how irrelevant were those emotions at that time? And you would just, probably the research ideas you were trying to come up with to say, how do I not have a trade on that doesn't have this type of drawdown, only to see it go right back to the highs and make another 50 ATRs. Some of these problems and concerns we have are so irrelevant.
And part of getting people to love and embrace the process is, of course, that they can look back on all our track records, and frankly, they are very good by if we're measured against our industry from all of us. But it doesn't mean that we won't underperform the industry maybe 2-3 years out of 10. Of course we will. So nothing is in a straight line. Nothing is easy, and you never get to a point where you're always on top. As you said, you had a great year, you felt great, but of course 2 months later, we may be behind for a little while, and so on and so forth. And And that's just the nature of the game. And once you embrace that completely and you internalize it, and I often bring it up when, after a great run, I actually like to remind our clients how this feels. Because it's about feeling, it's about how we feel about it. Because I want to be able to call upon, ideally, on that feeling when we're in drawdown and say, well, remember how it felt when we just had, like we've just had now, 6 months in a row, positive performance, right? How did that feel? And therefore, if you can remember that, then don't get too discouraged when we've had 4 down months in a row and are down 20% from a high or whatever, because it's you have to remember how great it feels, at the time when things are working.
For us, nothing's changed. Nothing has changed because it's systematic. I'm the same as I was when you were loving it and we were making all kinds of money, because it never was me. It was the systematic approach. Now the systematic approach is giving back profits. But I used to call the office in the 90s when I started hiring traders, and we'd have a round-the-clock group of traders monitoring the markets and putting in trades. And I would call before the iPhone or whatever, and to see, I'd say, okay, what's going on today? And they'd start going down the list of markets. And I could tell by the way they answered the phone if we were making money or losing money. And how stupid is that? They'd have this pessimistic hi, or they'd be very chirpy if we were making money. I was like, you've got to stop doing this. And so even though they were only executing, they're still a member of the team, and they want us to succeed. They want us to win. And so their emotions, were making me destabilized. I don't want to call those guys. You just cannot be influenced by performance.
And it goes back to what we talked about, I think, last time or the week before, and that is a big part of what we are being paid for. I think it's not just delivering performance and all of that stuff. It's actually also there to hold the hands of our clients through these periods and the emotional roller coaster, exactly as financial advisors do. I mean, there are some studies out where they have somehow quantified how much it adds to have someone to hold your hand through difficult times, financial advisor. And it's not just like 50 basis points. We're talking about, 2.5% per year in terms of better performance, which we know over time, over 20, 30 years, makes a massive difference. So if we can help people not sell the low and all of that, getting out at the wrong time, we're delivering an important service, I think.
It's been great listening to you guys, but there's one story on those trades, and it become, for our industry, it's custom to report monthly numbers or quarterly numbers, but for sure the annual numbers, right? And the annual numbers are the most important ones for whatever reason. We could also be reporting 12-month rolling returns, but it just so happens to be the case that on every calendar year we kind of take a stop and we record the P&L. So here's this thing. On the last business day of December, this I think 5-6 years or so ago, I had the entire portfolio up just a bit more than 1%. All right, so it looked like a positive year. It's an important day. It crystallizes a performance fee and all of that type of stuff, right? So what are you going to do? Are you going to close down the portfolio to save that 1% P&L? Or are you going to follow the process and trade your system? So as you guys may, probably guess correctly, I followed the system, right? And so I closed the year down at minus 20 basis points. That felt absolutely, what it felt like, right? But it was the thing to do. And so I called a friend of mine, and, he told me something which I think it's just, I remember it ever since. On the last business day of the month, you just tell yourself the month is still young. And that is absolutely true. And, everything and anything can happen in the last couple of hours of a month, of a quarter, of a year, and it may just, take your portfolio the wrong side. But that's the way we do it.
You should take the day off every last day of the month, actually, and, remove the stress. Let's jump into
the questions.
Yeah, well, there's probably just one, but it might be a little bit longer than usual. We'll see. Craig writes, hope you're doing well. Great show this week, as always. I had a theoretical question about trend behavior, which I appreciate all your thoughts on. It may be a bit long-winded, but here's the background to the question. The behavioral reasoning behind trend following is that there is generally underreaction to public information, price fundamentals, etc., and market participants take varying amounts of time, to disseminate their meaning and act accordingly, leading to herding behavior and trends in price. There's been lots of discussion about overcrowding in trend following, which I believe in theory should not eliminate the price trends themselves, but make the trends occur faster over a shorter time period. Here's my actual question. But what if actually the opposite occurred, i.e. less trend followers among market participants existed, at least measured relative to AUM? Shouldn't that make trends slower and more random looking when looking at short time frames, days, weeks, months? ? So first of all, thanks, Craig, for your question. Let me throw it to you, Moritz, first. What do you make of this idea or thought?
It's an excellent question, Greg. Thanks for sending that over to us. As you know, it cannot be answered with precision. None of us can have a precise answer as to, what our participation in the market is. But so the only thing I can do is I can share my feeling and observation and my belief of what's going on. I think that we as trend followers are not large enough relative to other market participants to have a meaningful influence on the longer term trends. Those longer term trends, they establish not because trend followers initiate it or kick it off. They establish because of different reasons. We're just there to follow them. Now, the other thing I want to say is that, when trend followers use similar types of trading strategies, and you may see that with those, flat fee or the bank-driven, more like simplistic type of trend following strategies, which kind of like work in the same way, and that leads to crowding around a specific entry or exit point. I don't think that this will destroy the trend in any way, but it will make the thing more erratic, the price behavior more erratic, and it may drop you out of a position because you have a quick reversal or something like that, a price action driven by the crowdedness that may kick you out of a trend before the trend then resumes. So it will be more erratic, but the longer term trend, I don't think will be influenced. Now, this is just, those are my 2 cents. There's no way I can prove that. It is my observation and my current belief, which, as you guys know, may change in 2 months' time as we get new information and new observations. But for the time being, this is what I think is the case.
Yeah, I agree with that. I just think that the way that I hear these questions, they're always the same, and my answer is always the same. It's just 2 different things going on. As if it's one, that's how the questions are always posed, but it's not. It's 2. One is the effect on trends. We're going to have trends. It's not going to stop trends. I don't even think it's going to make them quicker, slower, whatever. That doesn't seem to be the case. But now, issue number 2 is how is it going to impact CTA trend following as far as making money? You can have massive trends and none of us can make money. Oh, yeah. And that we've seen a little bit of this already happening because we've all had to change our look back from 1 month to multiple months, 10 months, 12 months, because the markets are way more choppy. And we're attracting people and computers and algos and bots to make the breakout so we can all get long, cocoa, corn, lots of examples that, before computers and algos, that stuff happened. Is it happening more? Well, rather than saying it is or it isn't, let's see someone do some research and say, oh yeah, we have more false breakouts. We certainly have choppier markets and violent sell-offs and vol targeting amongst large CTAs and I guess other insurance companies or whatever who are in the stock market who have to sell intraday when the market gets going. That causes issues. We have a lot of crashes and a lot of nice trends that get reduced to almost nothing in the commodities as well. So I think there are things going on. It's a worse approach. It's still profitable, I believe, and still can be profitable. But there's just no doubt that the evidence is there that it's the CTAs could kill trend following themselves if this sort of vol targeting and indiscriminate buying and selling and trying to throw around a lot of positions in commodities keeps going. But it can even happen in stocks. So there's just no doubt that the trends are much different.
Yeah, I mean, I think I think all of the things you both said are very important. I think in particular, what Moritz said about the fact that we as trend followers, we don't make the trends, I think is critical. I think there is some kind of misunderstanding that the more trend followers, the more trends, or the bigger the trends. I don't know that that is correct. So if we just take a step back and say, well, what do the markets really do? Well, markets are an efficient place for investors to express different desires, right? So Moritz may have young kids and he wants to buy a certain, make a certain investment for their, save up to college education. He makes an investment. Jerry, you might have, older children, and they might come to a point where you did your college fund 20 years ago, and you get to a point where you actually want to sell that because now they're out of college, et cetera, et cetera. So you meet on the same day and you do the trade, but you have opposite reason for doing it, but it's just an efficient place to do it. So what I'm trying to say here is that most of the time, markets just reflect the fact that there is so many diverse reasons for either buying or selling. There's no wrong or right. But from time to time, things change. It could be news, it could be, other things that makes more people want to go in the same direction. And that creates, to at least in my opinion, to a large extent, that creates these price moves. And still, there's nothing, wrong or right. And so it's not just trend followers is what I'm trying to say. There are a lot of other types of investors that from time to time decide that maybe it's a good idea to buy bonds. So bonds keeps going up because everyone is heading in the same direction. So it's this kind of herding behavior, but maybe not just as simply described as just, we do the same as the neighbor. We have different reasons for it, but sometimes those reasons are very similar, and that helps create trends. It's not a very eloquent way maybe to explain it, but we're always asked, so why do trend following works? And I think that's part of the reason why it really works, because it comes down to basically human behavior, but explained in a different way, hopefully. So I actually, to go back to your question, Craig, I don't know that we need to discuss or worry about the term overcrowding in the trend following space, because markets have always moved. I mean, historically, they've always moved. So markets moved 100 years ago when there were no trend followers. So how do we explain that? Markets move today when there are more trend followers. Yeah, but they don't move that differently, really. They may in the short term. I agree with that. I agree with Jerry on that there may be more noise. And I think there's an article out recently about noise versus volatility, I think it was. And so more noise can make it definitely challenging for trend followers. And that's why we've changed our look back periods to be a little bit slower to avoid some of the noise. But directional volatility has always been in the markets. That's nothing new. Am I completely off base here, guys? Or?
Well, I mean, I think that's true, but then you have a lot of choppiness and a lot of, volatility targeting that can torpedo these. You could hold on to these bonds for a couple of years and have all this open profit, and how much are you going to get out of it if there's tremendous volatility? We already saw that last week in the Italian bond, and I have no problem saying, well, that's not volatility targeting. Well, some of it probably was. So it was down 300 one day, maybe 100, 150 of that. And then it reversed. The fundamentals did not justify. I mean, I'm glad the fundamentals don't justify stupid volatility targeting. But I do think that it's just two sides. One is what you said and one is what I said. They're both equally valid. It is harder. It is choppier. You can try to defend against it by being longer term and having other trading techniques that don't give back all of your profits. But sometimes you will not be successful, and you will give back a lot more than you would have in the 80s and 90s because of the amount of trend followers that are out there who have to unwind their position in some of the less liquid markets, although it's not just the less liquid. And then you have more incentive of algo-driven traders who are trying to find our stops.
Right, I think that's important. I mean, I think that I think is, in my opinion, maybe even more important. I mean, I think there are a lot of other people now trying to do some kind of mean reversion type strategies that I also remember Stan Druckenmiller talked about, that he found it harder because once the trend goes a certain certain standard deviation away from kind of quote unquote the mean, then some of these algos will come in and try and push it down. I think that is true. I mean, there could be some vol targeting as well. I mean, who knows? But anyways, hopefully you got a little bit of color there, Craig, on your question. I think deep down, I mean, to kind of wrap it up a bit, given the fact that certainly you, Jerry, and us at Don, we've been doing it for such a long time, and the strategies are still making money. There's always going to be periods where they make more money than others. But I certainly wouldn't think that it's impossible for us to have some of the best years ahead of us, not necessarily behind us. Some of the extremes, some of the coordination between central banks and the involvement of authorities can potentially create some humongous trends, really. But as Ray Dalio also talked about, I mean, there are these paradigms or these, that can last for 10 years or so, where markets, go into a certain regime, and that regime could be difficult for any strategy. I mean, we're not the only ones where it's been a bit challenging. I mean, value investing has been incredibly difficult, and still is. At least we're having, as an industry, a great year this year. I'm not so sure value investors have that yet. So, anyways, any final thoughts as we slowly come to an end of our weekly conversation? I should say maybe a quick update on the live event. I think we've only got about 3 or 4 slots left. So if you are on the fence, thinking about joining us October 26th, October 27th in New York, Lower Manhattan, then jump off the fence, raise your hand, secure one of the last few spots. We would love to have you, and we're going to do our best to help you with whatever challenge you may have, whether you are experienced or whether you are relatively new. I think we can learn from all of the participants coming. So hopefully you'll be able to join us. Anything else, guys? Let me just maybe also bring up to date in terms of performance. I think yesterday, Friday, possibly was a bit of a down day for the industry. But as of Thursday night, the BTOP 50 index was up 2.21 for the month, up 10.93 for the year. The SocGen CTA index was up 1.22 for the month, up 9.83 for the year. The SocGen Trend Index up strong, 4.07 for the month, up 17.2 for the year. The SocGen Short-Term Traders Index up 1.16 and up 2.39, I think it is, for the year. And then the Bridge Alternatives Index up 4.96, up 14.57% so far in 2019. Anything else that you want to bring up? Any final thoughts? Obviously, we'd love more questions, so keep sending them to info@toptradersunplugged.com. love to hear from you. Thoughts, questions, anything?
Yes, keep them coming. I enjoy the questions a lot. I think they're very valuable. Probably one of the best things that we do in that podcast is answering them. I think it's great. So it's always appreciated when they come in. We like that. We also like to see you guys in New York at the end of October. It would be great to have a great weekend with everyone there. And other than that, enjoy the summer and happy trading.
I'm looking forward to maybe one of these days our first recorded question or comment.
Oh, yes.
How's that going?
Yes, we definitely want to. Maybe we should challenge Sam. Sam always says he wants to take us to the extreme. So now we're taking you, Sam, to the extreme. You should be the first one to record a message, maybe even a question. I'm not so sure about the question. The question is harder for us to play and answer. But maybe a message, Sam. That would be fun. And of course, you can do that by going to toptradersunplugged.com/voicemail. So Sam, that is your challenge from us. Other than that, I think on this note, we're going to wrap up this week's conversation, which we, of course, hope that you enjoyed. And if you want to support the podcast, then please head over to toptradersunplugged.com/review, where there is guidance to how you can leave us a nice comment and rating if you feel we deserve that. From Jerry, Moritz, and me, thanks so much for spending some of your day with us. We love the loyalty that all of you show us every week, and we look forward to being back with you in the next episode in a week's time. And in the meantime, have a great week.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on